Nilesh Shah of Kotak to understand what the status quo imposed by MSCI means for the markets at large. Mr. Shah, good afternoon. Thanks much for getting your coming on board to share your perspective. There's been a status quo on weight cap, which has brought about a huge relief for India, especially at a time like this when fund flows is a big trigger, is a big concern at the same time. How are you reading into it, and what is the kind of positive, what is the kind of benefit do you think the Indian markets can accrue on back of this development?
So it's a very positive development that MSCI has assured investors that they won't put any cap on emerging market like India for restricting access of the investors. In reality, if you see, India is the most open market. India's largest bank, largest telecom company, largest insurance company, largest mutual fund companies which are listed are majority owned by foreigners. And yet MSCI is accusing India of restricting access to investors. They earlier had announced that since National Stock Exchange is not sharing Nifty index data with Singapore, they will treat that as in restricting access to investors. Fortunately, after talking to investors, they have realized that they were in wrong direction, and now they have assured us that that won't be the case. It's a very positive development so that our passive flows, which comes from ETFs and index funds, will continue to come to India. More importantly, there is one more battle which India has to still fight. In MSCI index, MSCI Emerging Market Index, China's weight is about 28%, and that is expected to go up to 50% over next couple of years. It's not a one-year phenomena, it's a trend which will happen over a couple of years. And correspondingly, India's weight, which is at 8.9% in index today, it could come down. And as our weight comes down, it will have direct impact on passive flows as well as active flows. So we need to convince MSCI to treat India at par with China and don't make MSCI Emerging Market Index as MSCI China and other emerging market index. They should retain our weight at 8.9% or increase, as China's market cap is just 2.5 times that of India. Their weight cannot be 6 times more that of India.
Right. Nilesh, let's just talk about, the other issues which have been there. You've earlier spoken about it, the way it can impact on flows in India if there is a big upgrade for China. You think that's another big thing in MSCI to watch out for?
Undoubtedly. And if we just do a rough calculation that, let's say, rounded of India's weight is about 9%, and let's assume that majority of investors are overweight India at 12%. These are all hypothetical calculations because we don't have enough data to do real calculation. But there is roughly 33% overweight on India. And today, FII's ownership of Indian stock market, let's say rounded off, is about $400 billion. Now, if our weight goes down from 9 to, let's say, 6, then obviously the overweight position also will correspondingly reduce. And that reduction in overweight position will result into either new flows not coming in or actually redemptions coming and hitting us. And in terms of passive flows, ETF and index monies, there will be immediate redemptions as well as decline in the flows depending upon how our weight move. So obviously we have to ensure that we are treated fairly on line with China, and when their market cap is 2.5 times higher than us, then certainly their index weight cannot be 6 times higher than us. There is something wrong.
Nilesh, could there be any concerns going forward? Because right now, of course, there's a status quo that MSCI has pronounced for the Indian markets. Could that be challenged going forward? And if it does happen, actually, if there are any caps imposed, are there other options for investors in that case?
So, see, eventually on the long-term basis, fundamentals prevail. But in the short term, such kind of index changes could have material impact on market, and which is why we need to be precautionary. We need to be proactive. Now, for example, one of the couple of largest banks of India are not part of MSCI Emerging Market Index. MSCI's viewpoint is that FIIs are not allowed to invest in these banks because FII limit is reached. Our viewpoint should be that, look, every time these banks have raised primary capital, FIIs have participated. And in the secondary market today, between FIIs, there is open trading. They can trade as much as they want. And hence, it will be very, very wrong to exclude a bank where 74% ownership is with FII, but include a bank where 20% limit is there for FII to invest and only 10% is utilized. And hence, you are including that into index. We need to work with investors in Indian equity markets to influence MSCI that such kind of non-level playing field is not created between India and China.
Right. Nilesh, what do you make of the auto sales numbers? You always, big strategists, CIO, fund managers have always looked at auto sales as one of the key indicators of what's happening in the economy. What do you make of auto sales in November and December as we are getting there?
So definitely the slowdown in automobile sales is a cause of concern. However, it will be little bit too early to link that with economy because this has been caused by one, increase in insurance cost as the premiums have become for 3 years compared to 1 year. And second, the slowdown in NBFC disbursement as that sector went through a turmoil. My feeling is that market today is still watching out how this NBFCs and the banking systems will again start providing consumer financing for automobiles. And more importantly, how does insurance issues get settled out? So market today is not taking slowdown in automobile sales as a slowing economy. It's taking this as a sectoral impact because of these two incidences of insurance cost and NBFC finance.
Okay, but many people on the street at this point of time and for the last few weeks at least are saying that the liquidity concerns are actually have eased a fair bit. There's nothing wrong. The fundamentals also seem to be going okay as far as OEMs are concerned, as far as auto component makers are concerned. Why is it that the sentiment is so weak, and how much longer do you think it will prevail?
So one, clearly in automobile, consumer financing is critical. And today we have seen that many of the NBFCs are not growing their business as much as they were growing, let's say, 6 months back or 3 months back. And that has taken out financing for automobiles out. The second issue is coming in terms of higher insurance cost because you have to now take 3 years insurance together. Combination of these two is resulting into a scenario where we are seeing slowing automobile sales growth. And that's creating doubts in the mind of investors that how quickly these issues will be resolved and how will that result into higher growth in automobiles.
Right, Nilesh. Thanks.